Picture the late 1990s and you'd witness the greatest transfer of wealth in American history, with investors pouring trillions into companies that would revolutionize how we live, work, and communicate. Yet by 2001, over 80% of those same companies had completely vanished, taking with them nearly $5 trillion in market value and destroying the retirement savings of millions of ordinary Americans. The technology worked exactly as promised. The economics failed anyway. This discussion is for educational and analytical purposes only and does not constitute financial advice. What happened between 1995 and 2000 wasn't simply investor greed or irrational speculation. It was something more systematic, more structural. An entire generation of capital allocators, from venture capitalists to pension fund managers, fundamentally mispriced the basic unit economics of digital commerce. They understood the technology. They grasped the market potential. They correctly identified the transformative power of the internet, but they systematically ignored the physical constraints that would determine whether these businesses could ever generate sustainable cash flows. The contradiction runs deeper than individual company failures. The same technological revolution that promised to eliminate traditional business constraints actually created new ones that were far more expensive to overcome. Internet companies weren't just competing with traditional retailers on price and convenience. They were attempting to rebuild the entire infrastructure of commerce from scratch, in real time, while convincing customers to abandon purchasing habits developed over centuries. Consider what investors thought they were buying versus what they actually purchased. The narrative centered on network effects, infinite scalability, and zero marginal costs. The reality involved warehouses, delivery trucks, customer service centers, and logistics networks that required massive upfront capital with no guarantee of eventual profitability. Every additional customer often meant higher costs, not lower ones. Every expansion into new markets required duplicating expensive infrastructure. Every promise of convenience demanded investments in physical systems that the internet couldn't digitize away. This matters because the same structural mispricing patterns that drove the dot-com bubble continue to appear in subsequent technology cycles. Understanding what investors actually missed in the late 1990s reveals how markets systematically underestimate the gap between technological possibility and economic viability. The lessons aren't about avoiding technology investments. They're about recognizing when markets price in the benefits of innovation, while ignoring the costs of implementation. The most sophisticated investors of that era weren't naive. They had access to detailed financial projections, experienced management teams, and advisory boards filled with technology experts. Yet they consistently funded business models that violated basic principles of unit economics. This wasn't a failure of intelligence. It was a failure of framework. They were using analytical tools designed for traditional businesses to evaluate companies operating under completely different constraints. And the reason this hasn't been reflected in price yet is not what most people assume. The visible story of the dot-com boom follows a familiar pattern that most market participants understand well. The widespread adoption of the World Wide Web beginning in 1993 created unprecedented opportunities for entrepreneurs to reach global markets without traditional distribution channels. The Mosaic web browser and subsequent innovations made internet access practical for ordinary consumers, expanding the potential customer base from thousands of technology enthusiasts to hundreds of millions of households. Capital flowed toward these opportunities with remarkable speed and scale. Venture capital investment in internet companies increased from virtually zero in 1995 to representing 39% of all venture funding by 1999. The IPO market exploded, with companies raising hundreds of millions of dollars based on business plans rather than proven revenue models. Between 1995 and 2000, the Nasdaq Composite Index rose 572%, driven primarily by technology stocks that promised to transform entire industries. Low interest rates throughout the late 1990s made debt financing accessible to young companies, while changes to capital gains tax rates in 1997 encouraged even more investment in growth-oriented equities. The Federal Reserve maintained accommodative monetary policy, supporting asset price appreciation across technology sectors. Institutional investors, from pension funds to university endowments, allocated increasing percentages of their portfolios to technology stocks, convinced that traditional valuation metrics no longer applied to companies operating in digital markets. The regulatory environment supported rapid expansion. The Telecommunications Act of 1996 encouraged massive infrastructure investment, with telecommunications companies spending over $500 billion in 5 years to build fiber optic networks and wireless systems. Government policies actively promoted technology adoption through favorable tax treatment and reduced regulatory barriers for internet-based businesses. Media coverage amplified the excitement, with financial publications suggesting that concepts like profitability might be obsolete for companies focused on capturing market share in emerging digital markets. CNBC reported on technology stocks with the same intensity typically reserved for major sporting events. The Wall Street Journal published articles questioning whether traditional financial metrics remained relevant for evaluating internet companies. Individual investors participated through direct stock purchases and mutual fund investments, often allocating retirement savings toward technology-focused portfolios. Day trading became increasingly popular as individuals sought to capture quick profits from rapidly appreciating technology stocks. Brokerage firms introduced online trading platforms that made frequent transactions more accessible and affordable for retail investors. If you're interested in understanding markets beyond headlines, this channel focuses on exactly that. Companies responded to investor enthusiasm by prioritizing growth over profitability, spending heavily on marketing and infrastructure to establish market position before competitors could gain traction. The strategy appeared logical, given the winner-take-all dynamics many expected in digital markets. First-mover advantage seemed worth almost any cost, particularly when capital markets continued providing funding for expansion. By 1999, the most successful internet companies achieved market valuations that exceeded those of established corporations with decades of profitable operations. Amazon, despite consistent losses, was valued more highly than traditional retailers with stable cash flows. Pets.com raised $300 million despite never demonstrating sustainable unit economics. Webvan attracted over $1 billion in funding while struggling with the basic logistics of grocery delivery. This is the part most people understand. The part that actually changes the outcome comes next. The enthusiasm wasn't entirely misplaced. The internet did transform commerce, communication, and information access exactly as investors predicted. The technological infrastructure performed as expected. Consumer adoption exceeded even optimistic projections. Network effects did create sustainable competitive advantages for platforms that achieved scale. The vision of digital transformation was accurate. On the surface, everything still appeared to make sense. What the dominant narrative overlooked were the physical constraints that digital technology couldn't eliminate. Internet companies promised to reduce transaction costs and eliminate geographical barriers, but they still needed to move physical products from warehouses to customer locations. They offered greater selection and convenience, but fulfilling those promises required massive investments in logistics infrastructure that traditional retailers had built over decades. The unit economics revealed fundamental structural problems that technology alone couldn't solve. Take Pets.com, which epitomized the era's approach to customer acquisition. The company sold pet supplies online with the goal of capturing market share in the $23 billion pet products category. The strategy involved selling products at a loss to attract customers, with the expectation that volume would eventually drive down costs and increase margins. In practice, the opposite occurred. Pet food and litter are heavy, low-margin products that cost significant amounts to ship. Rather than achieving economies of scale, each additional customer often generated larger losses because shipping costs couldn't be reduced below the wholesale price of the products themselves. The company spent millions on marketing to acquire customers who generated negative cash flow on every transaction. Webvan faced similar constraints in grocery delivery. The company promised to eliminate the inefficiency of traditional supermarket shopping by delivering groceries directly to customer homes. The business model assumed that centralized warehouses and optimized delivery routes would create cost advantages over traditional grocery stores with their expensive retail real estate and labor-intensive operations. The reality proved far more complex. Grocery delivery required maintaining extensive inventory of perishable products with unpredictable demand patterns. Delivery routes needed to accommodate narrow time windows that customers demanded for convenience. The cost structure included not just warehousing and transportation, but also the customer service infrastructure needed to handle problems with damaged, missing, or incorrect products. Traditional grocery stores had evolved their operations over generations to minimize these costs. Their customers performed much of the labor themselves, from selecting products to transporting purchases home. Store layouts optimized inventory turnover while minimizing spoilage. The seeming inefficiencies of traditional retail actually reflected solutions to logistical problems that online companies had to solve from scratch. The technology platforms worked perfectly. Order processing, inventory management, and customer communication systems operated as designed. But the physical requirements of moving products from suppliers to customers created cost structures that made profitability impossible at any realistic scale. Each improvement in customer service increased operational complexity and expense. Even more problematic were the incentive structures that venture capital funding created. Companies needed to demonstrate rapid growth to justify continued investment, which required spending heavily on customer acquisition before understanding long-term profitability. The pressure to scale quickly prevented the careful optimization of operations that might have eventually solved unit economics problems. Management teams found themselves trapped between investor expectations for explosive growth and the practical constraints of building profitable businesses. The solution was often to raise more capital and defer profitability while hoping that scale would eventually solve cost structure problems. This worked as long as capital markets remained enthusiastic about technology investing. In theory, the approach was temporary until companies achieved the scale necessary for sustainable operations. In practice, temporary became structural as businesses optimized for fundraising rather than cash flow generation. This is where the same forces that drove growth begin to reverse. The Federal Reserve's interest rate increases in early 2000 marked the beginning of systematic capital withdrawal from technology markets. Between January and May 2000, the Fed raised rates 6 times, reaching 6.5% on the federal funds rate, the highest level since January 1991. The policy shift aimed to prevent inflation by making borrowing more expensive, effectively reducing the capital availability that had funded dot-com expansion for the previous 5 years. The timing created immediate pressure on companies that had structured their operations around continuous access to growth capital. Venture funding, which had represented 39% of all investment in internet companies by 1999, began contracting as institutional investors reassessed risk tolerance in a higher interest rate environment. Companies that had planned fundraising rounds to support continued expansion found themselves competing for a shrinking pool of available capital. The Nasdaq peaked at 5,048 on March 10, 2000, then began a systematic decline that would ultimately erase 78% of its value by October 2002. The selling accelerated on March 13th, when news of Japan's economic recession triggered global concerns about technology sector stability. By April 14th, the Nasdaq had fallen more than 25% in a single week, surpassing even the 19% decline during Black Monday in 1987. Individual company failures followed predictable patterns based on their capital requirements and runway remaining. Pets.com, despite raising $300 million, liquidated operations in November 2000 after determining that additional funding wouldn't be available to sustain its loss-generating business model. The company chose to return remaining capital to investors rather than continue operations that generated negative cash flow on every transaction. Webvan's collapse proved more spectacular, burning through over $1 billion before filing for bankruptcy in 2001. The company had committed to massive infrastructure investments, including automated warehouses and delivery fleets, that required continuous capital infusion to maintain operations. When funding markets contracted, these fixed costs became unsustainable regardless of customer demand levels. The pattern repeated across hundreds of companies that had prioritized growth over profitability during the capital-abundant period. Employment in Silicon Valley alone declined by 200,000 positions between 2001 and 2004 as companies eliminated operations that couldn't generate positive cash flows without external funding. The IPO market reflected the systematic reassessment, with new public offerings declining from 380 in 2000 to just 80 in 2001. Traditional financial metrics that had been dismissed during the growth period suddenly became relevant again as investors demanded evidence of sustainable business models. Price-to-earnings ratios, cash flow analysis, and profitability timelines returned to prominence in investment decision-making. Companies that had achieved actual profitability, like eBay and Amazon, maintained market support while those dependent on growth narratives saw valuations collapse. The infrastructure investments made during the boom period didn't disappear entirely. The fiber optic networks, data centers, and software platforms built with dot-com capital provided the foundation for subsequent technology companies that emerged with more sustainable economic models. Google, which went public in 2004, benefited from the communications infrastructure and reduced equipment costs that resulted from the earlier investment cycle. The consolidation process separated companies with viable long-term prospects from those that had been sustained primarily by market enthusiasm. Amazon, despite operating at losses throughout the 1990s, demonstrated that its customer acquisition and logistics investments could eventually generate positive returns as scale economies materialized. The company's ability to survive the capital contraction allowed it to benefit from reduced competition as less sustainable competitors exited the market. The regulatory environment also shifted as policymakers recognized the systemic risks created by speculative investment cycles. The Sarbanes-Oxley Act of 2002 introduced stricter financial reporting requirements designed to improve transparency and accountability in public company operations. The Securities and Exchange Commission increased oversight of investment banking practices, particularly around IPO pricing and analyst recommendations. Venture capital firms adapted their investment criteria to emphasize earlier paths to profitability and more conservative capital requirements. The due diligence process expanded to include detailed analysis of unit economics and competitive positioning rather than focusing primarily on market size and growth potential. Fund structures evolved to provide longer investment horizons that could accommodate the time required to build sustainable businesses. The human cost extended beyond job losses to include the destruction of retirement savings and investment portfolios that had been concentrated in technology stocks. Many individual investors who had allocated significant percentages of their assets to internet companies during the boom lost decades of accumulated wealth. The experience influenced risk tolerance and asset allocation decisions for an entire generation of investors. Yet the fundamental thesis about internet transformation proved accurate over longer time horizons. E-commerce did eventually capture significant market share from traditional retail, but the transition occurred more gradually and required different business models than those attempted during the initial boom. Companies that survived the correction and those that emerged afterward built operations around sustainable unit economics rather than growth at any cost. The mobile internet, cloud computing, and social media platforms that dominated technology markets in subsequent decades learned from the dot-com experience by focusing on capital efficiency and earlier profitability. These companies demonstrated that digital transformation could create enormous value, but only when technological capabilities aligned with economically viable business models. The systematic mispricing that characterized the dot-com period reflected broader challenges in valuing transformative technologies before their economic impact becomes fully apparent. Similar patterns have emerged in subsequent innovation cycles, from clean energy to artificial intelligence, where initial market enthusiasm often exceeds the pace at which underlying economics can develop to support valuations. Understanding the structural forces that drove both the boom and bust provides insight into how markets process technological change, and why price discovery often involves significant overshooting in both directions. The dot-com experience demonstrates that even accurate long-term visions can be implemented in ways that ignore fundamental economic constraints, creating opportunities for more disciplined approaches that balance innovation with sustainable business models. The system doesn't fail here, it tightens. The capital reallocation that followed the dot-com correction established new frameworks for evaluating technology investments that persist in current markets. Investors developed more sophisticated methods for assessing the gap between technological possibility and economic viability, though these lessons require constant reapplication as new innovations create fresh opportunities for systematic mispricing. The physical constraints that undermined many dot-com business models haven't disappeared with technological advancement. They've evolved into different forms that continue to create costs and complexity that pure software solutions cannot eliminate. Recognition of these persistent realities shapes current technology investment, though each innovation cycle presents new variations on familiar themes of growth versus profitability and vision versus execution. This is what remains unpriced for now. The tendency for markets to oscillate between underestimating implementation costs during enthusiasm phases and overestimating long-term potential during correction periods. The dot-com experience provides a template for recognizing when technological transformation creates investment opportunities and when it generates systematic mispricing that eventually requires correction through capital reallocation and business model evolution. The patterns that emerge from dot-com capital allocation continue to influence technology investment decisions today, though the specific constraints have evolved rather than disappeared. Modern venture capital firms emphasize earlier profitability milestones and more conservative burn rates, yet the fundamental tension between growth imperatives and unit economics persists across new technology sectors. The infrastructure legacy of the dot-com period created unexpected value that wasn't captured in the initial investment returns. Fiber optic networks installed at enormous cost during the boom provided the backbone for subsequent internet services that achieved sustainable profitability. Data center capacity built to support failed e-commerce ventures became the foundation for cloud computing platforms that eventually dominated technology markets. This infrastructure overhang illustrates a recurring pattern in technology investment cycles. Capital allocated during enthusiasm phases often creates more value than the specific companies receiving funding, but this value accrues to later entrants who can utilize existing infrastructure without bearing the initial development costs. The timing mismatch between capital deployment and value realization explains why early investors in transformative technologies frequently experience poor returns despite correctly identifying important trends. The dot-com experience reveals that markets consistently struggle to price the gap between technological capability and economic implementation. Each innovation cycle repeats this pattern with different variables but identical structural blindness. If this helped clarify how the system actually works, consider sharing it with someone who follows markets closely. Every innovation cycle solves one problem and creates another. Markets are very good at pricing the solution. They're consistently late pricing the cost.